Welcome back to page 6 and example 3. Okay, we've done control through purchase of net assets by paying cash, and now we're going to do it by issuing shares. Now, if on January a company issues 4,000 common shares, market value of $23.75 to B Corp, so again it's the company, not shareholders, as payment for the company's assets. The only time they issue to the shareholders themselves is if they're buying their shares. Now the cost for issuing shares totals 100. How will the company's balance sheet change compared to example 2? Now this is another thing you get a lot of in 400 level, and this course in particular, is they do everything all over again. They say, how will the company's balance sheet change? So you have to kind of scratch through some of your calculations and then either do them or go back to the other one and explain what's different. Okay, I'm going to do a combination of both here. See, usually if you're stuck and you really have problems with this, it's sometimes better to just do the balance sheets and see what happens. Okay, you might even find it halfway through and then you go, oh, okay, that makes sense, rather than sitting and going, oh my god, I don't know how to do that. Okay, start with what you know and go, okay, how do I do the balance sheet? Okay. Oh, and this should be net assets here, you guys. This is my fault. That should be net assets. Okay, so let's think of some things. This, what are we going to do with the cost? What did we say the cost for issuing shares we do? We debit common shares and credit cash. This price is given on acquisition date, which is what we want, so we're happy. Now, the first thing that can mess things up is if your goodwill is different, okay? So let's just write that out first. So, is goodwill the same as example 2? So that'll hinge, everything's the same, except we're not sure about this selling price here. So always with this, you look for, is consideration given up the same? So we said in one of those pages back there that if you issue shares, the consideration given up is the fair value of the shares on acquisition date. So we need number of shares times fair value shares on acquisition date. So there are 4,000 common shares, and on acquisition date they were $23.75. Always use acquisition date. So that equals $95,000. Let's look at example 2, what their goodwill was. So that's on page 4. Page 4, goodwill, consideration given up. Is it the same? Yeah, and is everything else the same? The balance sheets? Yeah, we're using the same balance sheets. So because it's the same, goodwill hasn't changed. Yes, it's the same. Consideration given up is the same. So goodwill is the same also. Is the same also. Okay, let's see the statement of financial position, or the balance sheet. So company A balance sheet or statement of financial position. Okay, so we've got assets. Leave space because we've got 100 we've got to subtract off. So how much assets did company A start? So go back to page 4. Assets are 300,000. Well, how much did we buy? Well, we bought B's assets. How much are they? 88 or 109? It's got to be fair value, so 109. And we shelled out $100 for costs. So that's 408,900. Should have made it 1,000. We didn't have to spread it all out, but that's okay. And we still have goodwill, and it's still 15,000. So that gives us 423,900 total assets. Now later on, you guys, we will be separating this. You'll have cash, AR, inventory, notes receivable. They'll all be listed separately. Right now we're just getting the idea across. Goodwill is always listed separately. It's like its own asset category. It used to be with intangibles, but it isn't anymore. Been accountant a long time. Okay, now look at liabilities. What did we start with? Remember, this is company A. Well, we started with 120 and we added on fair value or book value. Fair value is 149,000. Now, common shares. This is where it gets a little trickier. We started with how many? Okay, look at company A's balance sheet. We started with 100,000. Did we create and give out more common shares? Yeah, we paid with common shares. So these are our shares we're giving up. We're saying we're not going to give you cash, we're going to give you some of our valuable shares. So they gave 4,000 worth 90,000. So plus 95,000. But remember, this share costs to issue do not come out of retained earnings, they come right out of common shares. So we have to subtract that 100, which is 194,900. Now, do they have any retained earnings left? Yep. They started with 80,000. So it's the same. And they end with 80,000. So that totals 423,900. And that is our total liability and retained earnings. Okay, now the question is, and the only question is answering, how will the company's balance sheet change compared to example 2? Okay, so both companies. So here's A. Now B, we're going to go back, and I left space on the bottom here on page 5. So, example 3. Company B, how does Company B's balance sheet change? So here's the question. Here's the entry we did when Company B received cash, its net assets. What's the different piece here? What did they receive instead? Here they received cash. Example 2 received cash. In example 3, received what? Shares, company A. So this would be company A shares. What do we call it when we hold some other company's shares as our assets? It starts with an I. It'll be investment. Debit investment, not cash. Okay, that was B, or example 3. It's a little trickier because it doesn't say do all of this. Now I did, because this is your first time trying it, okay? But you could have just separated this out by looking at Company A's balance sheet and see what was different. Well, first of all, the 95 is different, the 100, and one's going to come out of one's going to come out of common shares. Retained earnings didn't change. You could have just looked at this way and done it that way. But your first time, I think it's just a little too tricky. But try seeing your way through this and make it work. See if it helps. Okay. Okay, I think I want to start this on a separate recording, so I'm going to stop this and start it again.